Have you ever questioned why securing the best loan rates is crucial to your financial health? Well, let's take a stroll down this financial lane. You see, loan rates, in a nutshell, are the cost of borrowing money. When these rates are high, you end up paying more over the life of your loan. Picture this. You borrow a sum of money, say for a car or a house, and due to high loan rates, the repayment amount balloons over time. As the repayment figure swells, it can strain your monthly budget, leaving you in a tight spot and making it harder to meet other financial goals. On the flip side, securing a lower loan rate means you pay less over the life of the loan. It's like getting the same quality product, but at a discounted price. Who wouldn't want that? So securing a better loan rate is not just an option, it is a financial necessity. If loan rates are so important, where can you find the most competitive ones? This question brings us to a viable option that many overlook: credit unions. These financial institutions may hold the key to better loan rates, but first, let's understand what they are and how they function. Credit unions are member-owned cooperatives, which means that they are owned and controlled by the people who use their services, the members. They don't have shareholders demanding high returns. Instead, they have members who expect good services and fair rates. This democratic structure is the cornerstone of credit unions and sets them apart from traditional banks. Now you might be wondering, how does this affect loan rates? Well, the answer lies in the not-for-profit nature of credit unions. Unlike banks, which are profit-driven and must cater to the financial interests of their shareholders, credit unions exist to serve their members. Their primary aim is not to make a profit, but to offer members a safe place to save and borrow at reasonable rates. The earnings of a credit union are returned to members in the form of reduced fees, higher savings rates, and of course lower loan rates. This means that when you take out a loan from a credit union, you're likely to get a better rate than you would from a traditional bank. And that's not all. The benefits of credit unions extend beyond just competitive rates. They also offer personalized service, financial education, and a sense of community that can be hard to find in larger banking institutions. So, before you head straight to your bank for a loan, consider exploring credit unions. They can be a viable option for better loan rates. But remember, as with any financial decision, it's essential to do your research and choose the option that best fits your needs. And now, if you're finding this information useful, consider hitting the like button and subscribing to our channel for more insightful content. Credit unions thus emerge as a potentially beneficial option for securing lower loan rates. And so our journey into the world of credit unions continues. Stay tuned as we delve deeper into the debate: credit unions versus traditional banks. But are credit unions truly a better option than traditional banks for securing lower loan rates? This question invites a lively debate, one that's been brewing for quite some time. On one hand, we have traditional banks, financial institutions that have been around for centuries. They're ubiquitous, and their scale allows them to offer a wide array of services. From checking accounts to mortgages, from credit cards to investment services, they've got it all. Their vast network of branches and ATMs also make them more accessible for customers across the country. On the flip side, this scale and wide reach often lead to impersonal service. Banks are profit-driven entities, and while they serve their customers, their ultimate loyalty lies with their shareholders. This can sometimes result in higher loan rates as they seek to maximize profits. Enter credit unions. They're not as widely known or as widespread as traditional banks, but they've been gradually gaining ground. Credit unions are member-owned and member-operated. This means that when you join a credit union, you're not just a customer, you're an owner. The profits don't go to anonymous shareholders. They're returned to members in the form of lower loan rates and higher savings rates. Credit unions also have a reputation for personalized service. Since they're smaller and community-focused, they tend to know their members better and can tailor their services to meet individual needs. But they do have their drawbacks. They may not offer as many services as traditional banks, and their reach may be limited, making them less convenient for some people. So, the debate rages on. Traditional banks with their wide reach and extensive services, or credit unions with their lower loan rates and personalized service? It's not a one-size-fits-all answer. It depends on what you value more: convenience and variety, or lower costs and a community feel. While the choice ultimately depends on individual preferences and requirements, credit unions certainly make a strong case for themselves. So, think it over, weigh your options, and choose the one that best serves your financial needs. Before we conclude, here's a subtle reminder to like and subscribe for more insightful content like this. We've journeyed far in our exploration of loan rates, considering the merits of both traditional banks and credit unions. We've seen how credit unions, with their member-focused ethos, can potentially offer more favorable loan rates than their traditional banking counterparts. By putting the needs of their members first, credit unions strive to provide competitive rates that can lighten the financial load. It's not just about numbers, it's about community, cooperation, and shared benefit. Yes, traditional banks might offer a wider range of services, but when it comes to loan rates, credit unions could be your secret weapon. As we wrap up, ask yourself this: is the lure of lower loan rates enough to make you consider credit unions over traditional banks?